All right, guys, let's get started. Let's get started. It's another day, another Facebook Live, YouTube's live. We're having a great time doing this stuff. All right, guys. So let's kind of get right into this. Now, how do you build wealth as a dentist or a doctor or a busy professional when you have zero time or when you have zero knowledge on how to invest? We don't know about the intricacies of the stock market and reading balance sheets of companies, nor the jargon of real estate investing. And why should we, right? We're doctors. This is not the focus of our professional programs. Now, we take our time learning to treat our patients. We take our time to help people become confident about their smiles and helping them achieve optimal health. Now, we keep focusing on taking CE courses and getting better and honing more skills so we become a better doctor to treat our patient pool, right? We keep on focusing on expanding and growing our businesses as well as the services that we provide to become more profitable with continued education, with consultants, going to conferences. So how do you take the time to add one more thing to your plate and learn how to invest your money properly? So that when inflation hits you, the monster of inflation hits you, you have a hedge of protection. So that when huge income taxes that we pay as doctors and dentists hit us, we have a hedge of protection. When a recession hits and deepens, we're prepared. So that when an emergency hits your family or your business, your bank account is protected. That's exactly what we're going to be talking about today. We are going to be talking about the value of apartment building investing and how investing in multifamily real estate can make the transition from high net income to high net worth. Now, multifamily real estate can protect your family for generations. I want you to just imagine yourself that in a year or two from now, your money is protected from taxes, it's protected from inflation, it's protected from a recession, and that the money sitting in the bank today or in the stock market in the negative will actually be making you money day in and day out with no days off. Now, how many people would really want to experience that? What's up, guys? My name is Dr. Jonny Walker. Jonathan Withanachchi is my practice name. I'm honored to be in this Facebook group with my fellow colleagues here. I'm going to let them introduce themselves in a second. Now, I'm an endodontist by trade. I've been an endodontist for 13 years, and I've been investing in real estate for over 12 years. I've been extremely successful in multifamily real estate investing. I'm the founder and principal of a capital firm called Walk of Wealth, which has now successfully invested over 690 apartment units, valued over $90 million of real estate. Now, next. Oh shoot! I still got the overlay on here.
I was about to say that.
Next, sorry about that. Next, let me introduce my colleague and co-host here, Dr. Noel Liu, and he is also a serial entrepreneur. And tell us a little bit about yourself and how you got started in multifamily real estate investing.
Hey, thanks a lot, Johnny. Yeah, my name is Noel Liu here, and I'm a general dentist based in Illinois. So I started my multifamily about a year and a half ago. My primary job is a dentist, and I still practice. I still love placing my implants. I still love seeing my patients. I still love doing a lot of things. It's basically my wife and myself, and we have a group of practice with associate doctors, and these guys are really, really great at what they do and helps me, kind of offset some of the time that I have with multifamily. I basically leverage with other people's time, experience, and track record to excel me to where I am today with multifamily. And Tom and I, we hit it off about a year and a half ago at the Grant Cardone Summit. And Johnny just recently, in about a few months with his Facebook group, after I found out Johnny and I, we are speaking the same language. So we just got together and we hit it off. So our thing basically focuses to make sure like our colleagues are understanding what real estate is and how do we take advantage of it. And we still do our day job while we can still practice and do investing in real estate. I mean, you can be an active participant or a passive. And we'll talk more about like the deal writing today as we progress. So I would like to pass it on to Tom, my buddy of mine, and he is also a serial entrepreneur. Hey, Tom, where did you go?
Happened.
Okay, good deal.
All right, guys. Hey, my name is Tom Varghese. I am a serial entrepreneur. I run a digital marketing company as well as a couple other businesses. Got into real estate about 2.5 years ago, and started investing in multifamily apartment buildings. Started with my own, and quickly realized that I cannot do it on my own if I want to scale. Today, so as a result, I partnered with others, and today I'm invested in about 300 units as a GP and about close to 1,000 units as a GP and an LP combined. And so excited to share what I have learned with Jonny and Noel, and so that every one of you, whether you're starting out, you're intermediate, you're expert, our goal is to take you from where you are to where you want to be. So if you're at 100 units today, we want you to be at 1,000. If you're starting out at zero, maybe your goal should be about 100 units in about a year time. So because, like Jonny says, this is one of the actual passive investments that really exist. Maybe many people talk about passive investments, and when you start to get into that, then you quickly realize it's really not passive. But this one, if you
Oh, Tom, I think Thomas froze there.
I was kind of hearing some echo as well.
Thomas, you froze, but we couldn't hear anything that you were saying.
go ahead. Last week was Noel. This week I think it's my turn to freeze.
Yeah, cool.
Nice. All right, so today, what are we talking about, guys? What are we chatting about? Before we get started, like, who here in our live here is, where are you guys from? Are you a doctor? Are you a dentist? We'd love to hear from you guys. We try to make this as interactive and try to make it as fun and informative as possible. So if you please pipe up, give us a thumbs up, whatever, however you feel. But Noel, so take it away. What are we going to be talking about here today?
Today, we're going to go back to the same basics of math. How do we calculate the valuation of the property? How do we calculate the valuation of a real estate commercial apartment building? It's one of those things where we are not comparing with the comps of the adjacent building or the adjacent house or any of that stuff. Basically, it's all dependent, it's all calculated, it's all based on the net income and what the cap rate is. So this is what we're going to be talking about. It's going to be pretty interactive. I mean, we're going to share a lot of thoughts, a lot of nuggets, a lot of ideas, and we're going to do a pretty much over the shoulder look kind of deal, where we are going to be looking at some of the properties on Crexy and LoopNet. And basically, this is how I do it, and I would like to share it with you guys. Like, when I'm looking at deals, I'm not underwriting every single deal. We are just basically doing like really fast calculation, which ones make sense and which one does not make sense. So we'll just quickly go over that aspect. But before we jump into that real life scenario and sharing my screen, I would like to go ahead and let's start with some numbers there, Jonny. You got the whiteboard?
Yeah,
ready?
sure.
So
Awesome, awesome.
basically anybody, if you want to invest in a deal, you invest in multifamily, you need to have a deal first. So that's what Noel is talking about, how to find a perfect deal so you can
Right.
put money into that.
So many of you guys ask that, how do I get started? How do I know like what's a good deal? Where do I look for these deals? Most of the deals are found through networking. Most of the deals are found through off-market and connections. But this is a simple and easy way to look at some of the deals that's on the market right now. All right, so Jonny, let's start with a very simple math here. We'll start with $1 million property. And let's say the rent is at $1,000 a unit and let's say it's a 10-unit apartment. Okay. So we got $1,000 times 10 units. Okay. So what is that, Johnny? That's $10,000 a month, right? So now in the multifamily, whenever we are calculating any of this number, it's always a yearly income or a yearly expense that we are doing. So we will do the 10,000 and we will times 12 months, which will give us 120,000. And that will be our gross income. Everybody following that so far? So what we did was $1,000 a door times 10 doors, we get 10,000, and that's per month. Then we times 12 months, and we get 120,000. So now that 120,000 is basically our gross income right there.
Gross rental income.
That's
Right.
correct. So, Tom, you want to elaborate a little bit on like how do we get to the NOI? Like what would you be like an expense? Like what would be a ratio? Like something we can just do it quickly over,
Yeah.
on the
So
national.
obviously, what Noel is saying is that this is what you collect as income. Now, just like any business, this is going to have expenses, right? What are the expenses? Definitely going to be taxes, big one, real estate taxes, insurance. You got to insure the property. So flood, all this stuff comes, you're protected, and don't worry about it. The bank will make sure you're insured before you do anything. So you're not going to lose money anyway. Then maintenance. There could be, some other, some maintenance. There could be doors that need to be fixed, windows need to be replaced, that kind of stuff. So those are the high level expenses.
And then we got payroll, then we have utilities. I mean, we have
Yeah.
all sorts of things that we can add in. Now, when we add all this in, Tom, what would you say like a good ratio would be about 50% in
Yeah,
expense
yeah,
to be on the safe
exactly.
side, right?
Yeah,
Like
you
property
should be.
taxes, insurance. So let's say we take 50%. Now
That's 50% expenses.
so our NOI, which is our net operating income after the expenses, will be at $60,000. So basically, this property for $1 million with 10 doors, we are generating $60,000 after paying all the expenses. Now, when I say all the expenses, this is not including bank debt. This is including just the regular operation of the property or of the real estate. So we got 60,000 that we are making as in NOI. Now, let's say this
What
cap
about other
rate.
income? Did you want to add
We're just
other
trying to
income?
keep it simple. We're just trying to keep it
Just keep
simple.
it simple.
Yeah,
Yeah.
yeah. Because then again, then we have to add in the
Yeah.
occupancy and the gross effect, and
Yeah.
then
Okay.
things
Cool.
get pretty complicated. I just want to keep it really, really simple for everybody.
Yeah.
So we got $1,000 rent per door. We got 10 doors. We're making 10,000 a month, and our rental income is about 120,000. Expenses are 60,000, and now our net operating income is at 60,000.
Yep.
So I hope everybody's following that, right? Now let's say if this was in a market where the cap rate is at 6%. So cap rate is basically the trading, basically I would call it, what is it? The return on if this whole thing was paid off in cash. So it would be at 6%. And that's really, really market dependent.
Yeah.
So
So basically, for the newbies, cap rate is like, let's say you go and buy a building with cash and you make a return after paying all the expenses. You do the math, and it comes to be maybe 10%, 6%, 5%, and all that stuff. So whatever money you're making
Yeah.
after all those, that's a cap rate.
So the cap rate, let's say, is at 6%, and it also depends on the interest rate as well as the market. So now we take $60,000, right?
Mm-hmm.
So we will take the 60.
Now you're showing
the
them how to
20.
calculate the value of the building, right?
Yes, yes.
Yeah.
So we take 60 and then we divide it by 6%, which is a cap.
1
So we
million.
come in 1 million. So I hope everybody's following that, right? So we got the apartment per door, then we times that by the number of doors, we get a gross income, and then we divide this, we subtract the expenses, then we get the NOI. The NOI, we divide it by the cap rate, and that's how we get the valuation of the property. Now, here's the fun part. if we were to play around with the cap rate, or we were to play around with the NOI by basically increasing rents or decreasing the expense, that $1 million will definitely get affected right off the bat. So Tom, what do you want to start with? You want to start with rental income increase?
Yeah, let's talk about how we can increase the NOI, right? What
And
is the
let's say
easiest?
everything remains constant. We leave it at 6% cap.
Yeah.
Okay.
And let's say you are able to, today actually I saw somebody post on my Facebook, a friend, he got the third rental increase in 12 months from the
Wow.
place where he was staying at. So that's what's happening across the board, guys. Rents are going up, but because of inflation to begin with. But then rental market is also super tight because why home values are going up. So people can't buy homes. Guess what? They got to have a place to live and they're going to go find rent a place to rent and the rents are going to go up. So now
Absolutely.
here,
So
let's say
here,
what $200 per door.
so let's do $200 per door. We
Okay.
just went in there, we increased it. Now we did not do anything with the apartments yet because we are in a hot market. So
So
we did
$1,200
$200
a month.
times 10 doors,
Yep. 2,000.
2,000 times 12 months. So guys, we just increased the rent by 24. I mean, sorry, the income by $24,000
Just by increasing the rent. That's
just
all
by
we did.
increasing the rent without decreasing the expense and without messing with the cap rates. So we did 24,000. Now you just divide that by 6% cap.
Whoa.
So we got an additional value of $400,000 on that property by just increasing the rent by $200. So this is how the valuation of the apartment complex it goes up when you just increase the rent.
And guess what? If you own that apartment, your net worth just went up by 40%, right? But from 1
Mhm.
million, if you own it, you just added 400 grand to your net worth.
So yeah. So let's say we are like we are four dentists. We everybody we put in 100,000 each as down
Yeah.
payment. We bought this $1 million apartment and we put in the down payment as 100 grand. Now guess what? We just raised the rent by $200 per month per door. We just got a valuation of $400,000 right there.
Yeah.
Okay. So
Divide
now
by
let's say
4.
what else can we do? What else can we do? So we subtract some of the expenses. Now the expenses is not 60,000, is down to let's say $50,000. So you add in another 10 grand there. So when you start adding all this extra right here, the valuation just keeps going up. So we added 400 grand here. So now we got another 10 grand and we divided by 6 cap. That's another $166,000 that went up.
Wow.
Right. So we just added like about $1.566 million versus when we got it for $1 million.
Right.
Even if in today's market, we go ahead and refi this property for, let's say, 70%, and we leave 30% in the property there. 70% of 1.566. What is it, Tom? You have a calculator too? I'm just
Yeah,
going to do
I'm
it real
putting it
quick.
up when I said that. It got me excited.
6 times.
You said 1.6 million, right?
Yeah, 1.6666. Right? We're just going to do that and we divide it by, we times actually 30%, sorry.
Yeah. I did times 70%, so we get a loan of 1.1 million. And yeah, that's yeah.
That's a 30%. And then what you do is you take that money, you pay off their previous loan, which was 700,000 or whatever we paid, like 600,000, because we were 4 dentists. We put in 400,000 as down payment. We borrowed 600,000. You pay
Right.
off the 600,000, and now
Johnny, I
you.
mean that's a great point you're saying there. Maybe Johnny should write that. Johnny, can you write that too? Like how they got into the building, 4 dentists putting 400K and they had to borrow 600 and now they're going to pay off the 600, right? And how much money are they left with after the refi? That's what you're getting at, right? No?
Yes, absolutely,
Yeah.
absolutely.
So you took four dentists, put 400,000 each, which is 400K.
Yeah, so I'm
Yeah,
just going to do the
loan.
math.
Then you put a
Guys, just
loan
bear with us. I'm just doing all this like, live right here.
impromptu.
So times 70%. So 70% is a loan that we pulled out from the bank. Okay.
Yeah,
So that is the amount. We subtract 600,000, which was the original loan we have to pay back. So we are left with $566,200.
that's pretty good.
So now think about it. We four dentists, we got our money back. We got our investment back, and now we also made an additional 166,200.
566,200, right?
Correct.
Divided by-
Correct. So as investors, this is what we are talking about here. You can definitely be fully active and take care of the deal, find their tenants, get it out on lease, or you can also invest passively, what Jonny was talking about, like if we really have the time as dentists, as professionals. But this is pretty much the gist of it, guys. I mean, when you are talking about the deals and when we are talking about valuation, this is how it's forcefully appreciated to the market. Jonny, you want to add any comments?
Yeah, he's got a lot to say. You're muted, by the
Oh.
way. Yeah.
No, I think that was a good explanation of how kind of a little bit about how value is added into multifamily real estate. Yeah, I mean, I think that we covered that pretty good, about increasing income, decreasing expenses is the way that you increase the net income, right? By increasing the net income based on a multiple of the cap rate, we increase the value of the property. So, really the take home message, I think for passive investors is that apartment buildings, multifamily real estate, commercial real estate, actually pretty much all real estate other than single family homes are based on the income that it provides and putting a value on that income based on what market, what demographic, what level of risk, what submarket you're located in. So all of those things will factor what exactly that cap rate is. But the name of the game in all commercial real estate is net income. So,
That's
and
right.
the way that you generate net income is either bringing up the income or with operational efficiencies, standard operating procedures, and good asset management, you bring expenses down. Either way, you have the same net result of driving profits and value, right? So,
Yeah, so when we look at a deal, I mean, when we are looking at least multiple deals, it's not about diving deep in it. Basically, we're just looking at a number of units. That's the most important count that we look for. The location, and basically it's what are the what's the asking price. If there is no asking price, you just basically go by the cap rate. And we'll do like a couple of demos right now where on Crexy where they have no asking price. And Tom, how many deals would you see like where it says TBD or like whatever, like as like market value or something like along those lines?
or
I mean,
inquire for
Yeah, yeah, yeah.
yeah. I mean, it was quite a lot until like a couple months ago. Right now, I'm seeing more deals being publicized with the price, but all these deals that are pretty good, most of the time they won't put the price. Especially 35, 36 units and higher, 40 units and higher, they don't advertise the price. So I mean, and Crexy is one of the sites where you can find these listings. LoopNet is another one. LoopNet usually is not the premium place where you want to find, but there are other places like JLL.com. There's local broker listing sites where you can find, but Crexy is what we're going to show, right? Is that right? No.
That's right. But the proper way of finding good deals is through a broker. That's
Yeah.
for sure. Your
By the way,
broker will have a list.
not your real estate broker. They have
No,
no
no, no,
clue
no,
about.
no.
Yeah, don't ask them about multifamily because 99% of them have no clue about this. So you need to find a commercial broker who specializes in multifamily units, and there's a lot in your neighborhood. Each city has its own, set of people.
Yeah, absolutely, absolutely. So
yeah, I
let's
mean,
see.
I know this is more of a passive investing group.
Yeah, so right, exactly.
And we're kind of just showing you this just because this is good practice for even a passive investor to know.
Yeah,
You know,
and then that's a good point, Johnny, because we still have like a lot of people asking like, hey, I want to own an apartment, I want to own, like a duplex or a quadplex. So this is also to help some of those guys. But at the end of the day, it's mainly passive. That's for sure. But just being a passive, also you should know like how the deals are underwritten or calculated or they even looked at.
And how we look at deals, I mean, before we buy it, right? Like how many times we talking about that deal the other day? I mean, so many deals we passed up to buy that particular deal that we are looking at right now. So,
How many of you guys can see the screen I'm sharing?
yep, there you go.
So guys, this is just I just pulled it up. It's not scripted or anything like that. We're just looking at deals here. So for example, I'll just pull up this apartment right here, which is a 52 unit. All right, so it's in Dallas, Texas. How many of you guys here from Dallas and know this address right here? 5207 Columbia Avenue, Dallas, Texas 75214. So this is an apartment complex. It's a C-class property. It's a value add, and it says occupancy 95%. So now here's the thing. Anytime you look at any of this item right here, you just kind of take it with a grain of salt. 95%, who knows? It could be 90, it could be 97, it could be 88, it could be 85, it could be anything.
Hold
Right?
on, Noel. Which one are you looking at? I see the one that with the maps and four.
Really? So you're not always, so you can't see the edit, the one that I clicked on,
No, I didn't see that.
the
I
addition
think,
and Haskell? No, you don't see it?
no, I didn't see. I don't see that.
Oh, sorry about that. Hey, did we lose Johnny?
No, I think he's there. Sometimes he. Yeah, there you go. We can't hear you, Johnny. You're on mute.
no, I'm here. I didn't want to cloud up. There's too many screens open because I was just gonna see what Noel's presenting this slide here.
When you click Noel, I think you might have shared the window, or the tab, which is probably why.
It's probably not doing it. Now you can see, right?
Somebody's saying there's a lot of echo.
Is it echo from my side? All right, no worries. This
Echo
this
should
is
be
how we
good
look
now.
at it.
Okay.
All right,
Cool.
so this is how we look at it. So the first thing that I look at is 52 units right here. All right, we know it's an old building, so it definitely falls in a C category. And basically, what are we looking at here? First, we look at the address, we look at the number of units, and we try to determine the cap rate. Now, the way we determine the cap rate is just call up the broker. Just go like, hey, you know what, Mr. Broker, what is going on with this deal here? I'm looking at this deal. I just want to know, when was it last traded? What is a cap rate? What is a whisper price? Basically, looking at all this good stuff here. So what I'm sharing with you guys is basically how we look at deals. So when I'm looking at this 52 unit deal, I'm going to be calling, let's say, the broker to find out what the rent is. If I can't find out from the broker what the rent is, I will look at in rent.com. I may even call up the apartment complex and go like, hey, do you have any availability going on? And one of those things they will find that they'll let me know is, how many units do they have available? I might just be like a mysterious shopper and I go like, I'm looking for maybe a bedroom or 2-bedroom, and I want to know like, when's your next availability. So that is one way I can find out, like, if this occupancy is it legit or is it like just made up. Then I might have like, Tom or Johnny call the apartment complex and go like, hey, can you find out availability? I might just put my name on the listing. So there are various ways, but the main thing is you want to find out how much the rent is. By just finding out how much the rent is and the cap rate is, we can actually calculate what this is going to be looking like, the asking price. The other way of finding out the asking price is just let your broker know, like, what is the seller expecting, or what is a broker's opinion on this property, like how much are they looking at. So there's various ways of finding out. And when you find out those aspects, you're looking at the price, then you're looking at your occupancy, you're looking at your rent, you're looking at your cap rate. Once you get a valuation on your side, is it close to what are they asking? Is it better than what are they asking? Or is it like way off what are they asking? And if it's off by what are they asking, I would call the broker back up and I'll be like, hey, is there any way that, these guys, what are these guys basing the price on? Is it because, like something else that I'm missing out, or what's going on? Because I will be getting the NOI, I'll be getting my calculation of the expenses, and I will know exactly, like in Dallas, we know in Dallas, the property tax is very, very high. So these are the kind of information that I'll be looking at before I get a valuation. And let's say if the deal makes sense on my napkin underwriting, then we will dive in and we will go ahead and underwrite it in more detail. It's not only going to be myself, it will also be a team, our CPA, then our other person, even the broker's underwriting will look at, see what's going on with that. So just to give you an example, if this apartment complex is C+, C. So if this rent, Tom, what do you think the rent would be in this place? Just looking at the pictures.
I mean, so by the way, oh man, look at that. That changed the whole perspective of my building. The outside looked pretty good. And I was like, man, that looks really good for C. But when I look at the inside now, I know it's C, right? So it's really, I mean, the rent really depends on the area. By the way, the class, if anybody is having a question about class, the best is like A plus. Then it's B, and then it's C, right? C could be like this older buildings, 1960 build, etc. So this one, I don't know. I mean, where in Dallas is this, by the way? Dallas, it's in the heart. So again, it all depends on the area. That area looks how close is Whole Foods, how close is Starbucks, how close is Trader Joe's. If those are all close by,
yeah, I don't think this is near a Starbucks or a Whole Foods. Okay.
So I would say maybe $700. I don't know. So
yeah, we'll just get, what is Dallas? We'll probably say like it's 900 to 1,000.
Yeah.
Okay.
Yeah. Dallas
So
is booming, by the way. So super hot right now.
What do you think the cap rate would be in Dallas? I think it would be somewhere around in the low 5s to like a high 4s.
Yeah, I think so. Yeah, but because it's Class C, maybe we can put high 5.
All right, so we'll do 52 units.
Well, by the way, guys,
it depends on that depends. It depends on the submarket. It depends where.
Exactly.
Yeah. Absolutely right. You're right, Jonny.
Let's say that it's a C building, and let's use a 6.5 cap. Cap rates are softening up a little bit.
So I was about to say that,
like, let's try
Class
that.
Yeah, let's say we just called the broker. The broker told us the cap rate is around 6.5, right? And the broker told us the rent is about average rent is about $1,000.
Yep.
So we got this information through the broker. So we did 52 units times 1,000. All right, guys. So what do we get? 52,000 a month.
Yep.
Which is about 600 a year, a little over 600,000 a year.
Times 12, so it's 624 a year, right?
Yep. 620.
Now we know that the occupancy is 95%. Let's make believe that these guys are 100% spot on. They're telling the truth. So we got 624 as in the gross income, and we're gonna do times 95%. So now our income dropped down to 592,800. It's everybody following that so far? So we took 52 units times 1,000, 52 grand a month times 12. We got 624. Then we did a 95% occupancy. Then we got it down to 592,800. So 592,800, again, we would do 50% on your expenses. So we just divided by 2. So right now, our NOI that I am showing right now is 296,400.
296,400
is the NOI. Now we asked Mr. Broker. Mr. Broker said the cap rate is what, at 6. So Jonny, you want to use 6% flat?
Or even 6.5, just
6.5.
Okay. It up a little.
Cool. Let's do 6.5. So we'll do 296,400, which is our net operating income after the expenses, divided by 6.5%. Can you guys see my calculator by any chance?
Not really.
I think you should
Okay.
stop share. Just stop the share because we got all the
Yeah,
information.
we got the
You got
data
all
we
the info,
needed.
right? Yeah, perfect,
Yeah.
perfect. Awesome.
Yeah, there we go.
All right, so just to kind of break it down, is this upside down or is it okay? All right, cool.
Yep.
So it's all right, cool. 52 units, 52,000 a month
No, you can't
times
see that,
12.
man. It's too blurry.
Still
Is it?
blurry. I think
Yeah,
it's
yeah,
the
Oh,
yeah.
I'm
Don't
sorry.
even bother with that.
Don't even bother
All
it.
right,
All
so
right,
look,
cool.
we got a gross income, right? We got 52 units, $1,000 a unit, 95% occupied. Now you said that gross income was what?
300K,
So we got
296,000.
All right, so the
so
gross income is
Sorry.
624.
$600K, right?
That was
$600,000 of gross income. Let's say that the expenses are a little bit higher. This is a Class C building. Maintenance is higher than 50%. You know, when we get into Class A stuff, we can run it more efficiently. Everything's brand new. We have smart, temperature controls, smart lighting, all that. So expenses go a lot. Those buildings can be operated much more efficiently. Class C buildings tend to have much higher because it's usually an older vintage. It's usually more run down because it's been owned for a long time with deferred maintenance. For all those reasons, the cost of maintenance also increases. Let's say that the expenses are not 50%. It's not that efficiently run. It's a older guy who's owned it for 35 years, let's say. You know, he hasn't done a lot of renovations. He's deferred a lot of maintenance because he's just trying to pull out as much cash as he wants as he can because he's using it as an ATM and not operating it properly. So let's say the expenses are 63%, right? So we can subtract 63% as expenses from that gross income. So 600,000 minus the expenses of 37% would give us a net income of approximately what?
All right, so you did 63%. That's giving us about 200 and change of net operating income.
How much? 200, about 200,000?
200 and let's make 210,000.
We got $210,000 of net operating income. NOI, this is the most important number here. So the net operating income is $210,000. This does not include any type of mortgage or debt service. This is how much the operations of this property will produce net of expenses. So we can put, if we own this property outright, it would give us $210,000 in our pocket if we didn't have any type of debt service or mortgage. Okay. $210,000. Now, what is that $210,000 worth on the market? So how much is an investor willing to pay for a property that produces $210,000 in that particular submarket, in that particular asset class? So we can put a value on that because in that neighborhood, we know that the cap rate is about 6.5%. So we take that net income, $210,000, divide it by the cap rate, which is 6.5%, which gives us a valuation for that property, roughly speaking, of $3.23 million. So we know roughly, just off the top of our head, just doing very rough calculations, this building is $3.23 million plus or minus $500,000-$700,000. Let's say.
Right.
So now when we approach the broker and say, hey, what is the listing price? And then the broker says it's $6.5 million. And we're like, wait, this is worth like 3.2 plus or minus 700,000. This is maybe worth 4 million max. This guy's talking about 6 million. That means automatically see you later to that deal. That means we don't need to go any further, going deeper into getting information from the broker. Hey, we would like to know more about this property. No, we don't want to know any more about this property because it's well beyond. We know that it's way overpriced.
Now we want to know less about this property and let's move on.
And you would come across a lot of
the flip side to that is you keep track of this listing because if people are smart, if other investors also realize, hey, look, there's no way that this property is worth this kind of money, then you know what? You stay in touch with that broker and be like, approach him in 3 months, 6 months, 9 months. And if this property is still not selling, then all of a sudden we get into a deeper recession. And this seller really needs to sell and is motivated by some type of extenuating circumstances of some type of distress. Now he might be willing to listen to, instead of 3.2, he might be listening to 2.5 or 2.4, so this is where great deals can also occur. So it sometimes helps to be persistent and keep track of these
you
types of
come
sellers
across
as
a lot
well.
of listings where they're asking, they think their property is worth something, and and realistically it's worth probably a couple million less. I mean, there is a lot in the market, especially today's market.
People get
They-
emotionally attached,
yeah,
to their
yeah.
buildings, and
So that's why
yeah.
you need to know the numbers. It's so important. I mean, it's you don't pull the trigger based on emotion. I mean, a lot of people, like I know a guy. He's like, he goes into deals. Is like, man, I saw that property and I got butterflies in my stomach. I'm like, no, that's not how you buy property. It's all backed up by numbers. If not, walk away. There's nothing that you need to be emotionally attached to any business. Period. It's a business decision.
Nice. All right, so I
No,
think
absolutely.
this is pretty good here, guys.
Yeah,
Should we get into a little bit of
question
Yeah, so this,
Q&A?
yeah, let's we don't have a lot of
before we
Q&A
jump into
from this time, but
Q&A,
we definitely had some Q&A from last time, the questions that we didn't answer, and then we can kind of start landing the plane here a little bit as well.
Noel, you were saying, did you have a question?
Yeah, go
Noel?
ahead.
no, I was just saying before we do the Q&A, I just wanted to, like, everybody just take a little pause and just kind of think about this, like when we're doing the valuation here. Nothing is speculated.
Yeah,
There's no speculation. It's not like, it's some voodoo magic. It's not like, you're giving a money to the stock market and hoping for the best. It's like everything is calculated. And when we calculate it, you actually want to make sure that you're calculating based on the market, based on where the rents are at, and how much can you increase based on the comps of the other apartment buildings of similar class and similar size. So everything that's put out there in terms of numbers and underwriting, it's all math. It's all basic math. So, just think about it for a second. Like, when we are investing, I know, like, a couple of guys, they brought up the point that, hey, is GP putting their own money in? Is people putting their own money in? Of course, everybody has skin in the game. GPs have skin in the game from day one when they put the LOI in. So it's like when we do these math here, it's not only about the investors, it's also about everybody else that's got to win. So I just wanted to throw that out there for everybody to just to kind of like absorb this a little bit.
Yeah, that's a great point. That's a
Great
great point.
point.
Yeah, I love that. I love that there's an objectivity to evaluating properties. So whereas when you're buying home prices, right, houses, single family houses, it's based on comparables. So there's a little bit more subjectivity onto what exactly is considered a comp. Here, when you're evaluating commercial real estate, it's objective, right? It's based on numbers. These numbers can be creatively manipulated by brokers and people as well. And that's where appropriate due diligence comes in, right? So, that's another side of it, another side to that thing. Noel, one question that, I've spoken to probably 25, 30 people in this group itself. And the most common question that comes up by far is, hey, look, I'm very interested in being a passive investor. I love what I want to build multiple streams of income. I'm a busy doctor. I'm a busy dentist. I just don't have the time to go out and figure out what is going on. I don't know where to get started even. I don't know who to trust, and these are very, and this is a big money game here, right? This is not like investing $1,000 in the stock market. This is investing $50,000 to $100,000, $200,000, $500,000 at a time. So the room for error is lower, right? If capital preservation is what we are about. So how would you answer? Where would somebody get started? How does somebody that doesn't have the time, doesn't really know about, and then there's the other group of doctors. They were invested. They've been to some Brad Sumrock. They've been to some events. Now they're on an email list for 30 people, and they're getting their email is full of offerings that, hey, IRR, blah, 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 cap rate, blah, 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 equity multiple, blah, blah, blah. It's on a beautiful presentation. Everybody looks like they know what they're talking about.
Right.
Who the hell are you supposed to trust? How do I know which one to go with? You go on CrowdStreet website. Oh, you could go through 30, 40 different listings. Beautiful.
Like the crowd listening that just happened. Right.
How the heck do we know where to get started, right? What do we look for? How do we know who to trust? Let me put that question to you guys. I mean, what do you guys think?
I mean,
Silence is golden, guys, but not right
are
now.
you asking? Are you asking us? Oh, yeah.
Sure,
I
yeah.
mean,
I mean,
Noel,
listen, this is a
Noel,
question
go
that's
ahead.
posed to us from many
Yeah,
members on the
I'll
group.
take it after Noel. Noel, go ahead. Who to trust? How do I get started? Basically, that's the main question. You're 100%
I
right,
always
Johnny.
say,
A lot of people have asked me that too in the group.
yeah.
Yeah, great. Go ahead.
I can't speak for anybody else. However, I would definitely would like to speak for myself when I got started. It's, yeah, you're looking at the numbers, you're looking at everything else, but the main thing before you get started, it's like you have to know your math, you have to know your homework, you have to do your due diligence in a sense that you know who those guys are. Or do you know who those guys are? Did they just meet up? Did you just see them? Have you been following these guys? Have you been seeing like what kind of work are they doing? Are they providing any value to anything, or are they doing any kind of deals themselves? There's a lot of gurus out there. There's a lot of people out there that are teaching all this stuff here, but they're not doing deals. I mean, Johnny, I'll be honest with you, man. Like we doing deals, okay?
Yeah.
There's a lot of people out there who's going to teach you all this crap, but none of them are doing it because they don't have their own skin in the game. So number one is you got to know people who are doing it. If I want to learn how to play a piano, I'll go to somebody who's actually playing piano. That's somebody who's teaching it. If I want to learn how to do business, I'm going to be like, after somebody who is actually doing business, involved in business, not through some business school, like, who's just teaching it. So that's number one. Number two is your track record and your experience. That comes down to the same thing what I just said. Knowing what they're doing in their business lives, what are they doing in their personal lives, what kind of moral or ethical character they have. It takes a while before you can actually trust someone or even say that that is the right person, because you still have to follow those. So for me, when I started with my first deal, I actually had to like sit down on the sideline for a little bit and watch what was happening, and then I went ahead and I put my first $50K in a deal which I felt comfortable with. So
I love that. That was a great answer, Noel. So I think he hit two important points there. Number one, partner alongside experts, people that are doing it, have done it before, people that are in the field doing deals. Like Noel said. I mean, all three of us are the general partner side. We're doing deals active right now.
Yeah, great point there. So
just one more. So I try to just summarize kind of Noel. Then we'll go to you, Tom. And then the other point that Noel said is, number one, alongside the expert. Number two, this type of investment is an illiquid investment. This is investment that your money's gonna be tied up for 3 to 7 potentially years, but plus years. You have to partner alongside people that you know, like, trust, and verify what they have done before. Always trust what people are telling you, but always verify. Trust but verify. So look at these guys' track records. Look at their references. Follow up call some of their investors that have invested with them in the past.
Mm-hmm.
Right? These are some of the simple due diligence things that we do.
And one more point, Johnny.
Yeah.
One more point. I believe you should invest with people who are actually equal to or better than you.
Oh yeah, sure. Yeah.
Okay, because a lot of times, you don't want to invest with somebody who's less than you, or who has less net worth than you, or somebody, because you will run into problems. It's like, when we go to financial institutions, who are we trusting? We're trusting these financial institution agents, these guys. I mean, they are like on the W-2 jobs, and they are selling us products which they don't believe in themselves, and they're not buying it themselves, but they're selling it to the high net worth individuals like us. So, I mean, that is the first thing you got to take a look at and see, like, evaluate and take a step back and see, where do we stand, we as professionals? Why are we trusting our money to somebody who's not even believing in their own product? And they're going to get paid regardless of, whatever happens if the market goes up or down. So that is another thing that I, kind of drive me nuts when I see these kind of things happening.
Yeah, I agree, man. No, it's 1,000% true. That's a great point. Thomas, you wanted to add something.
Yeah. So
how do passive investors get over the hump of, hey, I know I want to invest in real estate. I know that real estate can build cash flows. It can build wealth. It can give me multiple streams of income so I can escape. How do I get started? Thomas, what can you add towards that?
Like the first thing is like, so I just wanted to say this. It's okay to sit on the sidelines and do analysis and all that, but at some point you got to take action. That's what we see. Noel and Jonny, you see a lot of these guys. They're doing analysis, checking deal after deal. 2 years have gone by. They've not invested in a single deal. Guess what? They lost out on that 2 years of return. So now, how do you get started, right? So Joe and Jonny and Noel were saying, like, you got to be comfortable. Like, you got to know these guys. If they're if they're a dentist, are they doing well as a dentist, or are they just starting out? I would just check how they're doing, right? Like Noel and Jonny, these guys are doing amazingly well as dentists. They have taken their business, their practices to the next level that many dentists and endodontists aspire to be. So they're already successful in that. You could check my business. I've three businesses. I'm very successful. I mean, I've scaled businesses from zero to seven figures in 6 months. So I know how to scale. So you got to check and see how these guys are doing first. Like Noel was saying, a lot of these guys out there, they teach about this. They do interviews. They got bring people on the show, and they do interview after interview, and they're selling courses, tickets, things like that, but really not doing deals. But we three, I'm not asking us, by the way, you guys, this is not a pitch, but I'm saying we three actively are involved in deals ourselves. Several hundred units under our portfolio we have invested. So you got to check up and see. And then at some point, you also have to see what are these guys? These guys approachable? What is their personality like? Are these guys like some stuck up guys? All these things come into play. But at some point, once you're comfortable, rather than sit on the sidelines, you got to take action and jump in. And then you will see for yourself how it's working. So, I mean, that's what I got. I thought I'd add for that to what
Yeah,
you
no,
guys.
that's a huge point too. One of the things that I've learned in my mastermind group is that success follows speed, right? Speed of action, speed of urgency, execution, just actually going out and doing something. Now, I'm not saying that you should run out and make an investment based on, hey, look, I just need to make an investment and go out. No, absolutely not. The due diligence aspects of the investment should be done meticulously, should be done slowly. But after that, if we've identified this, as a great opportunity, you have had other people look at, other experts, guys have done this before, track record, have given you green light, your professionals that you actually trust, that actually do real estate deals, not your accountant or financial advisor, but actually people that are invested in real estate. They've given you the okay. You know that this asset you have a good gut feeling about it, but still sometimes I've had investors in my firm that everything is in line. They have the cash. They need to invest it. It's getting eroded by inflation. This is a friend of mine. She's an attorney. She's been on the sidelines for several of my deals now. She's been at the webinars listening. She wants to get invested. She's booked extra calls with me. We've done emails and all of this. Everything is there, and elements are there that this is a good, safe investment, strong fundamentals. This is a low risk, high return type of play. And still, the people it's just a mental hurdle, right? Mm-hmm. There's people that everything is aligned, everything is there, but it's just that I'm scared to do it. I'm scared to invest in this deal. And those people, I'm telling you, it's about that's where the massive action comes in. It's about taking massive action and taking decided steps. Like once you've decided, hey, look, I need to create multiple streams of income. This money in the stock market is not working for me. The 401k plan is the exact same place it was 8 years ago when I started contributing the money for it. But yet you're not hesitant to keep money in the 401k. Why? Because we're just indoctrinated by these financial advisors, by every player in the game. Like, this is this thing that you're supposed to do. Put it in the stock market. Don't listen to anybody else. Leave it locked up for long periods of time. Don't think about it. If you touch it, you'll get penalized, et cetera, et cetera, et cetera. those people are the ones that are gambling. And like, to me, it's like, here's an opportunity that you can actually let money work for you in a tangible asset that's proven recession resilient, which is an asset class that the wealthiest families in America invest in. The wealthiest families in America don't invest in 401k plans or SEP IRAs. They just simply do not, right? But a lot of wealthy people invest in multifamily real estate. Guys that have made billions of dollars in other industries when they've sold their companies, they've sold their businesses, they don't leave it sitting in the bank account. They just let it ride in a multifamily real estate, which will just churn out cash flow. It has the tax advantage of the depreciation. That's the key. That's the key to building freedom. So if we know this, it's still getting over that mental hurdle of, I don't want to let that money go out of the stock market or take it out of the bank account and put it. I know this is a great investment, but I still can't do it. Massive action. I think that's another huge impediment for a lot of investors that could just be getting started on their wealth building journey, but just getting over that mental mindset. And I think mindset is huge when it comes to investing. Investor mindset is very different from somebody with a scarcity mindset. Somebody is scared and doesn't want and would rather have inaction and would rather let it sit in the bank. Those people, they know that there's a better way, but it's getting that mindset. I think so. That Thomas, you hit that on the head huge there.
Jonny, what I think it is? I
Brian
think
said right here, paralysis by analysis paralysis. Right.
Yep.
Jonny, I think one of those biggest pointers that you just pointed out is because we all have very short-term vision. And when we have a short-term vision, we cannot see past that 2-year or the 1-year mark, that what our money is going to do for us. And I think that's where a lot of people get paralyzed because they cannot really visualize. They always underestimate that what's going to happen. And that's one of those biggest hurdles. The reason I'm saying that is because I used to think that way. And I'm always giving my prime example. That is how I was.
Analysis paralysis is a real thing.
Uh-huh.
The thing
100%.
is, you keep looking at a deal and you second question and second guess. But once you've already gone through the whole preliminary step, and then you go back and you start second guessing everything. And then you're like, well, what if this happens? And then I add this analysis in. And then all of a sudden, exactly how my friend, Dr. Brian Craven, who's a good friend of mine and the dentist in the Massachusetts area, he's also an investor in our company. Brian said analysis paralysis. This exactly right. And this stops people from investing. It does.
Elias, good to see you on the live. He's saying that's old thinking. Absolutely, that's old thinking. Melissa, great to see you on the live.
How come I can't see any of these? I don't see any of these.
I got Raphael. He's also one of my investors.
Oh yeah.
Hey Raphael, what's up, man? How you doing?
How are you guys seeing this chat? I don't see this.
I'm going to Facebook to see it. So just go.
It should be showing up on here though.
No, it's not.
Huh.
Yeah, here it is, but we don't see the name. So Melissa, I see that. Yeah, I can see her name. Yeah.
Hey, you know what? You know what? I just want to say one thing though. This is the last year of 2022 to get the depreciation bonus, right? Now, here's the thing. A lot of people, they're not ready to invest in multifamily or any of that stuff. But here's my plea to all our colleagues: just get in the real estate game. I mean, even if it's your own dental practice, right, Jonny? I mean, get in the dental practice, jack up those rents, get in a strip mall, have one of your practices in one of the spaces, get a buddy to buy the strip mall, and let's rent out the other 5 units out there. Okay. And you can do the same exact thing where we do with multifamily. If you got 10 units that you can rent on the retail space, one of them is a dental practice, put it up for rent, get the TI, give those guys a little bone to, chew on, and then get them in, jack up the NOI. It's a triple net, and just go refi, pull your money out, and get that depreciation. I mean, this is the way to do it, guys. I mean, even if you don't want to do it in multifamily, do it in something.
Yeah, absolutely. Okay? You got to pull the trigger, guys.
You got to pull the trigger. Yeah, absolutely. This is the last year, so let's take full advantage, because this is the last year you're going to get 100% bonus depreciation. And if you don't trust a sponsor, it's fine. You don't trust multifamily, fine. Just invest in your own dental practice, in your own physical, like medical office building. Buy something, and put that money to work.
And we only have 2 months left. Today's October 25th. 2 months left, and nothing happens during Thanksgiving, last week of Thanksgiving and Christmas. So you got to move fast. We are not, although we are working on a deal right now, that's not the reason I'm saying this. We are saying this for your benefit. I mean, I was like this too. I would like, wait, but last year, 2020, I decided to pull the trigger. 2021, wired 25 grand, joined the mastermind, stuff like that. I took massive action. I mean, I'm glad I did. So just want to applaud you guys. I mean, ask you guys to do the same for your own benefit, and it's only going to pay off in the long run for you and for your family, for your generation.
Absolutely. Absolutely. I love it. I love it. So with that being said, Johnny, did you want to land the plane today? And
Yeah, man, land the plane.
let's kick it off for
Yeah.
the next Facebook Live.
Facebook Live, guys. So we're gonna be going live every Tuesday. They're not gonna. So next Tuesday is gonna be a restream. The week after that's gonna be a new live. So November 1st we'll be restreaming this live again. November 8th we'll be back in the studio, back here doing our next actual live presentation. So look for the notifications. If you have any questions, reach out to us. We're here to help as a resource. There's a lot of very smart and talented investors in this group as well.